Hey y'all, we're gonna go through the topic that everyone loves, the option chain. How do we read it? What contract should we purchase? How do you know exactly what all these numbers mean? And it's honestly very overwhelming as a beginner. I was very overwhelmed, and from this video, it's gonna make a lot more sense as to what exactly is the most important things to look at. How do we understand each line, as well as which contract you should be choosing when you trade. So here I do have a paper trading account right there. So what the numbers you see are paper trading money. It's not real money right here, but it's essentially the same layout as real money when you do trade. All you have to really understand here is when I close these tabs, how to get to this page. This is Thinkorswim. This is my broker with all these different tabs. Click on trade. And then what you want to click on is all products. If you start clicking these other buttons, they're just other things. I would just click trade and then all products. This is the page you want to be on to get the option chain. And for this is for options trading. So let's just type in a ticker. So I'm going to keep it at SPY, so SPY. You just type the ticker that you want right here and then you press enter. So nothing really else to do. What you want to click on from here is going to be this option chain button. Click that, and this is the page that I originally showed. Now, the very first thing you should be doing is closing all of these other drop downs. All that you will see here is going to be dates. These are the expiration dates of the contract. Because this is SPY, SPY and QQQ have different expiration dates. So you can get expiration dates any single day of the week, whereas a certain stock always expires on a Friday. So you can see here from all these rounding numbers, it's just every single day. How do you pick these? Well, we're going to go through that in a second. But I just wanted to show you how you can customize this first, because once we customize it, then I'll show you exactly what all the numbers mean. Not all the numbers that you have on default is what you need. How I have it and what I like to use when I'm trading, you want to go up to this area. It says layout. Click on that, then click customize. From here, now you can choose exactly what type of numbers you want. So from here, you could see the last X, net change, bid, ask, and then it's the same on this side. Bid, ask, last X, net change. I don't use any of these numbers. The only thing I need to use are delta and theta. We can get rid of all of this. So here, all I would do is drag it to the left side. You can see it disappears. For this one, click on it and drag it to the left. That is how you remove it from this list. And once you press like OK, this will show up here. But what we want to do is click on delta and theta. So you scroll down, it's all alphabetical. So delta is going to be up here, delta. You click on it and then you drag it to the right and then it shows up. Go all the way down and then you go to theta, click on it and drag it to the right. Then all you have to do right now is click OK. Then it shows up on the screen, delta, theta, and then of course bid and ask. Bid and ask are always going to be on the screen. It's only these columns is where you could customize which ones you want to see. Now that we're on this page and we just clicked on this random expiration date. So this is 17 October, which is 1 day from now. So today is 16 October. And so this number here in the little brackets just shows that it is 1 day later. That is what these means. 2 days later, 5 days, 6 days. That's how you read those numbers. And then for all these, it just shows 100. 100 just meaning that whatever number you see here, you have to times it by 100. And that's how much it costs for you to enter a trade. So even for one contract, you have to times like this number, 1.99 times 100, and you're gonna pay $199 to even enter the trade. Now for these columns, I'm just gonna go through the definitions. So delta and theta, why did I choose that? Going over here, I want to go through the main definitions of delta and theta. The importance of Greeks is that they influence the price and behavior of options. So this is going to be for options trading specifically. If you're trading other markets like forex or futures, you won't need to know the option chain. Now, what do? They affect the price of an options contract as well as its value when in an open position. So an open position just means that you entered a trade, and then from there, how does that profit and loss move? Then the fun stuff, delta and theta. So I have this in brackets. Basically, the delta number is a good thing and the theta is a bad thing. Over here, I've tried to break it down as easy as possible. So let's read it together. For every $1 change in the stock's price, the option will increase or decrease based on the delta value. So it basically means that if price goes in the direction that you predicted, either it goes higher and price increases or price decreases, this is where you will earn money if you're correct. If an option has a delta of 0.5, so let's go back to that screen so we can really reference and have a visual comparison as to what this means. If an option has a delta of 0.5, over here, delta is here, you could see that it's in decimals. So say that it's 0.49, 0.74. If this number is a 0.5 here, and you buy a call option for $300, so where is this $300 coming from? It is coming from these numbers here. So that's why the bid and ask is so important. This is what you're gonna pay for the contract. So in that definition, when the delta is 0.5, it said you will be paying 300. So in this case, if you're paying for a delta of 0.51, what you'll be paying is between $198 and $199. So whatever the decimal that you pick, this is what you'll be paying. It's either gonna be this number or this number. And what I click on, I always click on the ask. So I always buy a contract at the ask. So whatever delta I choose, say it's 0.21, I'm gonna go all the way here and I pick this. So this is gonna cost me $55 because that is 0.55 times 100. So it's basically $55 to execute a trade. Then going back here, it says, and the underlying stock increases from $60 to $61 per share. This just means that on a chart, say that you're looking at TradingView, when you're looking on the right axis, it says, all the different numbers. If it says on that axis, like the stock is at $60 and then it just goes up by 61. So maybe the chart goes from, a certain level to another level. If that is a $1 move, you basically earned $50 because you just times the delta by 100. So that's what you'll see on the options contracts. That is the kind of the pattern there. Whatever number you see here, you times it by 100. So if you want to pay for a contract, you're going to times that by 100. That's how much you pay to get in the contract. And then once price moves, if price goes in your favor, so you predicted it correctly, you expect price to go higher, you do calls, then you're going to earn $50 based on that one contract. So the more contracts you buy, so this is $199. If you buy 10 contracts, then over here it would be $50 from that one contract times the 10 contracts. So that will be $500. So whatever you have here, times it by 100 and then times it by the number of contracts that you buy, and that will be your profit here, delta. Then going to theta, this is the bad one. Theta indicates how much value an option loses with the passage of time. So this is basically just time decay. This is the one thing that futures and forex don't have. Only options does it have time decay, which is why a lot of people like to trade futures or forex because there's no time decay. So this is the more complicated market, I would say, because you have to worry about when you're in a trade, if price even increases, it could increase over time. So the chart goes higher, you made money, but because of the time decay, if it takes too long for price to get to a certain level, then it could actually mean that your contract will decrease. So you may actually end up losing money even though you predicted price will go higher. So that is the time decay and why it's bad. How you want to choose a contract is going to be based on if you're scalping or day trading, whatever contract you choose, you need to be taking note of the theta. If you choose a contract with a very bad theta, and I'll tell you exactly what is bad theta. If you choose a contract with, say, a bad theta, then it means if your contract goes up and you predicted it correctly, you expect price to start here and it goes to this point. It went up, but then because it took too long, even though it went higher, the time decay ended up making the contract lose money. So then you ended up losing money even though you predicted it correctly. So what you want is the alignment where you predict price correctly, you pick good options here, so a good theta, a good delta, and then from there, if it's strong, you will gain money. If it's a weak movement, it takes too long, you may end up losing money in the trade. My example here, if you buy a call option, so predicting price is going higher, for $200, so that means that on the options chain here is likely going to be 2.00. Then going back, if that costs you $200 with a theta of 0.5, so on here we have theta and this is a decimal, if that shows a 0.5, it suggests that the options value is expected to decrease by $50 that day. All you have to do is times this 0.5 by 100 and you get that 50. So just like delta, times this delta number by 100 and that's how much you gain. Times the theta value by 100 and that's how much you lose. After one day, the value of this option is 150, you lost $50. That's basically what it means. So whatever the theta is, you lose that money however long you're in the trade. That is why when you're trading options, you want to pick the right strike price and the right expiration, because based on what you choose, you can determine how well or how strong the theta and delta move and how well you can maximize your profits. Now we got the main definitions on. Let's go back to the Thinkorswim platform right here. So you can see delta, theta, bid and ask, and then you have the strike prices. And the only other thing you have to look at is up here, above all these columns, you see calls, and then you see puts. So what is reflected on the left is just like a mirror image. It just shows calls, you're predicting price is going to go higher, and puts, you're predicting price is going to go lower. So that's just a bull market or bear market basically. Then in the middle, we'll show all your strike prices. And then you can basically click on this and show however many you want to have. So maybe you don't need to have these many numbers. If you click on say 6, there'll be all these lines. So there'll be 6 lines available. But just to show, you can pick as many as you want. You could click all. You don't need to see the whole running list. Once you know exactly what type of line you typically like to choose, you don't need to have revealed so many lines unless there's something that you want to pick from way far out, then you'll want to pick all. But as a beginner, you don't need that many to look at. Then from here, the strike price, the middle will reflect a date. This is the date that we clicked on right here. So whatever date we choose, say we want to choose the 25th of October, click that. The strike price, this is the date that will show up here. So whatever reflects here is going to be up here. Then in the middle here are all these numbers. What do they mean? These are the numbers where price is at. So you can see here, 579, 580. What is the current price of SPY? So if we look on a chart, all the way on the right axis of all those different numbers, it shows 579.78. So that is how much SPY is at. And that is also the number if you want to actually invest in that stock or that ticker. You're going to pay that much money to buy one share. That is different from options. Options is having the right to buy and sell a contract, but when you own an actual share, that is when you long-term invest or you hold that share until it increases to a certain point for retirement or just bigger investment gains. So the current price right here is going to be reflected right here. That is why you see 2 different colors. You can see a black area or a purple area. Where that line distincts itself, so where this color changes from black to purple, that is where the current price is at. So where it changes is between 579 and 580. And you can see from here, this number is exactly between 579 and 580. That is why these numbers change. And throughout looking at the option chain, as the number changes, so maybe SPY gets to 573.5, then all these numbers will move down. You'll see 573 and 574 down here, and then the colors will change. So that's how it moves. As this price of the ticker moves, all of these numbers will change as well. So when you're looking at this in live time, you'll just see different numbers move at once. And that's where it can get very confusing. So we want to understand this when the market is closed. That way we don't see a bunch of running numbers and colors. Now that you understand the basic terminologies here, delta, theta, bid and ask, expiration, and strike, this is going to show on every single date that you choose. If you click on this date, it shows the exact same thing. So from here, let me just go through a quick understanding of in the money, at the money, out of the money. These are terms that you may hear very commonly in trading. So we'll go through the definitions and then we'll go back to which strike I choose. I typically choose the same strike price every single time I trade. Now that we're here, let's scroll down and look at the definitions. This is where it gets very complicated when you're understanding different things. So I just focus on how does this information benefit me? How do I understand this definition and how does it directly impact what I need to know from executing my trade? In the money, out of the money, and at the money are basic terminologies of just areas here. So like different lines are going to be called in the money, or different lines are going to be called out of the money. If we go back here, what the basic definition is when you say in the money, it's less risky and it costs more. So you're paying more money because you know that trade is going to work out. And then out of the money is more risky, there's lower chances of success, and because it's lower chances of success, it's going to cost less. You're kind of paying for something that works out very well. Then at the money is less risky and the cost is in the middle. To understand that visually, let's look down here. This is definitely going to help you understand it much better. This is the same thing we saw in the option chain. I just highlighted the areas of what they really mean. Now, when you're looking at this whole area, we have the expiration date and we have those strike prices. This is the in the money area, out of the money, and then at the money. And here on the right side, it's kind of flip-flopped. So you can see like out of the money is at the top, where out of the money here is at the bottom. So in the money costs more money. So you can see even from these ask prices, these are very expensive contracts. You are paying $2,540 for these contracts, like much higher, whereas out of the money is much cheaper. And then here, when you see this, it costs a lot more at the ask. If you can read here, it costs something like $2,315. So that's how you differentiate between out of the money and in the money. Really just look at the ask prices or the bid prices. It's gonna really tell you these bigger numbers means it's more expensive. And then this line here is at the money. That just means that the contract is exactly where current price is at. So here, what you wanna do is when you see this separation of colors, it is that first line here that is at current price, so just below it. On this side, it's above that line. So with that separation, at the money is just above that separation of colors. That is essentially the different names and terminologies from in the money, out of the money, and at the money. Now that we have covered the general definitions, let's now understand this page. Now, which exact line should you be clicking when you're in a trade? I'm going to speak specifically on day trading and scalping. This is the more generalized, and majority of you will be day trading or even scalping. So within the day, you're buying or selling contracts. Choosing the right line is going to be all dependent on the strategy you have, as well as how much money you're willing to put in a trade. So of course, like we looked at the picture, the higher you go up here, the more expensive it gets. So $714. Are you okay paying $714 to get into the trade? Typically, if you're just starting out, this is not an amount I would recommend anyone to start off with. This is very expensive for you to enter a trade. The higher the amount you get in a trade in, the bigger the loss. So are you willing to lose such a big amount? If you choose whatever line, that is the maximum amount that you will lose. So say that you buy this for $714. The worst that you lose is this total amount of money. The maximum you can lose in trading is however much you enter the trade for. So if you paid $199, the maximum that you will lose in that trade is going to be $199. We can't always predict how fast price will move. So suddenly if there's an event happening or some speech happening, if there's some crazy erratic behavior and you predicted price to go higher, but it just tanks, right away you could be wiped out from your trade. So you always want to choose the right strike price where it's an okay amount that you are okay risking, and then are you okay with how the volatility moves? If you reflect on the delta and theta, these are going to be the two columns that I'm going to focus on to choose which strike price that I want. Now here, what I told you earlier is when you times this by 100, you'll either make $89, or if you choose something here, you may only make $20. Theta, look at that. If you may lose $35 or you may lose like $22. What I'm focusing on is delta must always be higher than theta. That is what I always look for. If delta is higher than theta, so if I enter a trade, say that it goes up by $1, I make $49. But if it goes down by $1, that means I predicted it incorrectly. I lose $49. So besides your P&L, whether you gain $49 or you lose $49 based on whether you predicted correctly, you're still gonna have a time decay. Why would I choose something that is such a high theta, which means like it's a bad thing, over something that's good? I wanna choose a Greek where the positive Greek is much higher than the negative Greek. That's just my rule. So looking down here, because we clicked on different dates, we're gonna have different numbers shown. So here, even if I choose $49 here, this is 49 gain, and then an 87 loss. So this is bigger than this number. The theta is bigger than the delta. I'm not liking this. Then if I go to maybe 23 October, so I go further down, you can now see the delta and thetas are very different. Now we can see that delta is $52 and here is 31. This number is significantly higher than this number, so that's a good thing. Delta is higher than theta. That's exactly what I want to see. That is going to be my main focus on determining which strike price I want. So if we go down the list and maybe you're not familiar with which expiration you typically want. So let's see, going down the list, maybe we click on 16. Over here, 48 versus 118. That is very bad. Theta is much bigger than delta. So I'm not even going to look at this whole area because all the thetas going down here are much higher than the delta. Now you could look up here where maybe up here, the delta is much higher than this theta. However, are you okay paying $400? It's all based on, is this number higher than this number? And then are you okay purchasing that contract for this amount? I choose my contracts really based on these two columns and then of course the ask price. So would I be willing to risk $675 per contract? I usually don't like to pay that much for just one contract. I'd rather buy something here where maybe I could buy 5 contracts for the price of 1, and then it's less risky. But then if I pay this much and I'm okay with paying $118, well, the thetas don't align. So then I skip to the next date. Going down to the 17th, the next date, we see here, the area where I want to pay these prices are okay, maybe within the 100 to 300 range. I look at these numbers, how do they look? Theta is still bigger than delta. So I'm going to X out that date and then go to the next one. 21st October, how does this look? Delta is higher than theta, that's a great thing. Am I okay paying $331 to get in a trade? This seems reasonable, and then I would choose to pick that contract right there. Same thing with puts. If you expect price to go down, what you want to do is you want to see, is delta still more than theta? So here, the 0.44 is still higher than the 31. That is a good thing. Am I okay paying maybe $300 around there? Am I okay paying with that? If it's a green light, then I'll click that contract. So you really just go down the list one by one. Are you okay paying this amount of money, times it by 100? Am I okay paying 412? Am I okay paying, 818 for one contract? If I'm not, I don't like the delta and theta, I'm gonna skip to the next expiration date. It's more straightforward than you think. Once you understand how they move, so maybe you could dabble in with different lines and test out, maybe I like the second line from the midpoint, or maybe I like something in this area, or maybe I like this area. Which area do I like and which line works best for me, which works for my strategy, whether I like to trade for the whole day, a very short scalp. Try different lines based on, paper trading, you could try that. And once you find something that you really like, whether it is a cheaper contract or a more expensive, and how the delta and theta moves, then you can choose that contract like every time. 99% of the time, I'm always choosing the same contract. That contract is going to be at the money. I choose this line specifically, the one that separates the two colors. So I'll typically take this line, or I'll take this line based on whether I want to do calls or puts. That is 99% of the time what I usually pick, because the delta and theta are usually ideal, the price is ideal. And if it's not, I go to the next expiration date where they all align the same way. So after watching this video, you should really just try out different strike prices or different expiration dates And from there, you get a better understanding. It's easier to really understand this once you experience it rather than really trying to have it explained. That's not something that can be taught, really understanding how it moves, because once you're really in a trade, only for yourself will you be able to understand how that P&L moves with this option chain. If you want a deeper dive of this option chain as well as a lot of the other definitions that I did mention, I do have all these in my beginner trading book. I'm going to link it in the description, and it's going to have everything that you need from start to finish, as well as how to execute a trade. I execute all my trades on my phone. I found the platform much simpler. So if you want to know how I execute it, I have an instruction manual in the book as well. So check that out. It's very important that you understand everything that you need before you actually really start getting into paying real money to enter trades.